We're looking at the Euro-US dollar daily chart, and on the chart I've highlighted some of the triangle formations that are visible. If we start off on the left hand side here, we can see the descending triangle that's formed around about February through till April time in 2012, and the way that this has been formed is from a strong move up, creating the highest high of that period. The pull back again to a very similar level, therefore creating the beginnings of a horizontal zone. Pushing back up again, failing to breach the previous high. So we've got the lows that are similar, a lower high, price comes down again to this same level, it's an obvious horizontal level now, and pushes back up again. And it's the fact that there's a horizontal level along here, and then the descending trend line through here, which creates the descending triangle. Now, when we get these descending triangles, we're looking for price to move to the downside and break through the horizontal level. And the easiest way for us to tell the break of the descending triangle is when price moves outside of it, which we can see happens first of all on this bar here. However, it's not actually confirmed until we get a close outside of that zone. And if we zoom in a bit more, we see that it was indeed this bar here that gave us the close outside of the triangle, which confirmed the move to the downside. Again, it was the horizontal zone here that got broken, first of all, but the close beneath actually confirmed that we're expecting price to move to the downside. And looking at that descending triangle, we can see price moves a long way as a result of the break of the triangle. And this is just one example of a descending triangle. But the interesting thing is how we move from descending triangle into, in this case, a symmetrical triangle. And the difference is between a descending triangle and a symmetrical triangle. A descending triangle has one horizontal level that gets broken. Symmetrical triangles have no horizontal levels. They are trend lines that get broken. So we have a high and a low, lower high, higher low, lower high. Basically, price is moving into a wedge and it's getting more and more indecisive. And it's these higher lows and lower highs that consistently create this wedge shape, which eventually then breaks. And same as with the descending triangle, it's the first close outside of that we expect to look for the move to continue from. So this close here closes outside of the triangle. As a result, we expect the price to keep moving to the downside. So we see here there was testing through, testing. We never got a close outside. And then this was the first close outside of the triangle, and price, sure enough, moves to the downside. If we look at potential entry and stop criteria for these triangles, a sensible place to enter on the descending triangle would be to wait for the close of the bar here. And you'd then be placing your stop loss above the most recent swing high. That would mean an entry around here and a stop loss up here. We just color code that so that the entry is in blue. We can see the blue would be the entry once price is closed outside, the red would be the stop loss. And we would continue to move the stop loss down behind this triangle or behind the price action. So as a new lower high forms, we'd be able to move our stop loss down. As a new lower high forms, we could then move our stop loss down, and so on. With the symmetrical triangle, it's a very similar thing. We have the entry, in this case being the close to the downside, outside the symmetrical triangle, and our stop loss would go behind the previous high point. So the blue would be the entry, the red would be the stop loss. As price moves down in our favour, pulls back, gives us the lower high, we could move the stop loss behind that area as it moves back down again. Of course, this trade would make slightly more than break even, but it's a very, very small winning trade. We can see there, the blue would be the entry once price is closed outside the triangle. And we can see again and again that's very, very key. If we look at this descending triangle, we're not looking to trade this to the upside. The descending triangle, we're taking a break of the horizontal level. With a symmetrical triangle, we're looking for a break of that wedge. And we have another symmetrical triangle here, a little bit smaller, but we can still see prices at the low, the highs, the low, the high, the low, the high, and then it breaks out. And this is a very convincing breakout as well. And in this example, this third example now, our entry would be on the close of this bar here when it breaks out. Let's zoom in so it's a bit clearer. And our stop loss would be underneath the triangle at that point in time. And as price moves in our favour, we would move our stop loss under the swing low, under the swing low, and so on, and so on, and so on, until we then get stopped out of the trade. We can see with these triangles, price typically moves quite aggressively once it's broken and closed outside of the level, so outside of the triangle. That's the really nice thing about triangles, is once they go, they really tend to break quite aggressively, and that's what we're looking to trade. Once we get the confirmed close outside of the triangle, that's the direction that you would look to take the trade. In order to get a descending triangle, we need to have at least 2 to 3 touches. 2 touches with the third one breaking through on the horizontal with a descending triangle. So 2 to 3 touches, 2 touches creating the beginnings of the level, the third one can then push through. It's just nicer to see 3 touches and then the breakthrough. And again to the upside, 2 to 3 touches that are descending clearly. With the symmetricals, obviously we're not looking at any horizontals now with symmetrical triangles. It's all about the wedge shape. We need to see at least 1 higher low and at least 1 lower high. Again, it's nicer if we have 3 touches, but 2 is still acceptable. If we look at a few more examples now, just to see what else has been setting up, we can see an ascending triangle on the pound US dollar. We see 1, 2, 3, 4 touches to the ascending part of the triangle, and we see 2 touches followed by the breakthrough to the upper horizontal line part of the ascending triangle. We see the strong move up, pull back, move up again, pull back, and then the breakthrough. And sure enough, we can see it's an aggressive move to the upside. If we look at the actual closing bar here, we can identify this was the bar that closed outside of the triangle, therefore that would be our entry point. We will look to enter on the close of the bar here. Our stop loss will be underneath the previous lows. Just make this red so that we can see it's a stop loss. And we have our stop loss underneath here. As the price moves in the direction we expect, the stop loss can be moved underneath the swing lows to lock in the profits. Again, another nice ascending triangle there, nice winning trade. Look at a few more. We can see a symmetrical triangle here that's led to a huge move. We can see the leg up, the leg down, the leg up, the leg down, and then the breakthrough. 2 touches, 3 touches to the downside, 2 touches, and the breakthrough to the upside. And we can see what's happened. Price has moved aggressively, pulled back, moved again, consolidated, and moved again. It's unlikely that you capture this entire move from the symmetrical triangle, but there's no doubt this would have resulted in a winning trade. If we're looking at the actual entry criteria here, it's more than likely that the entry to this trade would have been the close of this bar here. Let's just highlight that with an arrow. It would be this bar here that would give you the actual entry, because that's the close that's outside of the triangle. And we can see after that price moves in our direction. And a few more. Bearing on this isn't just applicable to the daily chart, these work on all time frames. If we have a look at some of the higher time frames, like a weekly chart for example, we can also see examples here of 1, 2, 3 touches to the upside, 1, 2, 3 touches to the downside. But of course this is an ascending triangle, so we're looking for the breakout to the upside. This close here is the confirmed move outside of the wedge, outside of the ascending triangle. We then get the pullback, and off it moves strongly in the direction that we expect to the upside. Again, the closing bar here, the close of the bar would have been the entry point, stop loss underneath the triangle, underneath the price action, and we'd have then moved the stop loss underneath price action to lock in profits along the way. These wedge shapes are visible on all time frames, on all markets. We have another one to look at here as well. Price moving down, price moving up. And we can see that it was this close here that gave the trade, with some movement to the downside. It's unlikely that this trade resulted in any real profit, but it certainly got us into the trade with the opportunity to make some profit there. Not all of these trades are going to work out. Some of them are going to fail. But at the same time, you'll very often find that when traded correctly with the close outside of the triangle, we tend to get very high success rates, high probability, good reward to risk trades. We see another wedge on the daily charts here for silver. We have the prices moving up with higher lows and the lower highs, which give us this symmetrical triangle formation. The strong close to the downside there would have given us the entry, and this is an example of a losing trade because price moved down then instantly reversed off the level. Fair enough, we're going to take some losers, but at the same time we can see that a lot of these trades will work out nice and successful. Move over to gold here, we can see this symmetrical triangle, several touches to the lower part of the triangle, several touches to the upper part, and it's the close outside here that gave us the entry into the marketplace, the close outside the triangle, which then resulted in a very healthy profit. What you'll very often find with triangles is that they'll actually break, pull back, and then move. Some of the trades will just go aggressively in your favor from the breakout, but quite a few will break, pull back, and go again. And that gives us another way of trading ascending triangles or descending triangles or even symmetricals, is actually to wait for the pullback. Let price break, let it pull back again, and then find your way into the position. An example of that here would be to enter on this bullish pin bar, because price has broken the triangle, pulled back to the triangle, and given us a buy signal with price action, and this resistance has become support, and we can see price moves aggressively. If we look through some of the previous examples, the Canadian dollar, on the weekly chart, there was no retest straight away. Maybe there was no trade. However, you can also see this could have been classified as the retest. If we go back and look at the previous ascending triangle over here, we see the break, we see the pullback, we see the reversal bar here from seller bar, buyer bar. This could be a potential entry point into the market. Alternatively, you've got the ring low formation there. So any of the bars around here would have been potential entries into the marketplace. It's more than likely it would have been this buyer bar here. Seller bar, buyer bar. The shift from sellers to buyers off of that horizontal level gives us the reason to want to be in the trade. And the nice thing is, when we get into trades on the retest, we can see that they aggressively move in our favor. If we get into trades on the break, we see they very often pull back slightly before they go. Rather than getting into the market and watching it sit still for a period of time, or even go against us slightly, it's nicer to trade the retest, because trading the retest is psychologically rewarding, as price tends to go in our favor a lot quicker. If we look at some more of those examples, for example, the dollar yen back here on the daily chart, we can see here on this one there was no retest, there was no re-entry point. So sometimes it's going to go and it's going to leave you behind. But other times you'll get your ascending triangle here that breaks out, a pullback, reversal bar formation, and we can see that shift from seller bar, buyer bar. That could be our entry point into the trade. It's just a slightly more conservative way of trading these breakouts. Rather than entering purely on the close of the bar, if we enter off one price at bar itself rather than the entire formation, we can get a smaller stop loss. So rather than trading this ascending triangle like this, if we did it off of a retest, rather than having a 300 point stop, we could have an 80 point stop. It's a big difference. You don't mind some of the trades disappearing and running away when the ones you do get give you much smaller stop losses. Less risk and, as a result, higher percentage gain from the big winners. If we look back through at the Euro US dollar here, we'll look at some of these. We can see the breakthrough. Let's move this. We can see the pullback in the form of the bearish pin bar, the high test bar here. This could be a potential sell signal to get us into the trade. And at other times, like this one here, there will be no retest. So it's up to you as to how you choose to trade these triangles, but essentially you can either enter on the close outside of the triangle and enter on the breakout, or you can wait for the retest, and the retest will tend to give you a higher reward to risk trade. The downside of waiting for the retest, of course, is you will miss some of the breakouts. Spend some time now going over your charts. Any time frame, hourly, 4 hourly, daily or weekly. Pick a currency pair and go through and just try to identify some of these triangle formations on the charts. Have a look and see what you can find, and just draw them on using the trend line tools in MetaTrader so that you can easily identify them. I can see another one on the chart here that I haven't shown you yet. I'll just locate it. We can see here we have a symmetrical triangle. Touch, touch, retest to the downside, another retest to the upside, the close outside confirms it, and off it goes. Granted, this would not have been much of a winning trade at all, but it does highlight for us another symmetrical triangle. But even if we look at these and say, okay, 1 winning trade, 2 winning trades, 3 winning trades, and 1 loser, it's still a very nice position to be in. So again, go through and look at these charts, find several ascending, descending, and symmetrical triangles, and just practice drawing on the lines on the chart and identifying them. Don't mind which time frame you use or which currency pair you use, just make sure it's something higher than an hourly chart and a currency pair that you would ordinarily want to trade. Not something like the Hong Kong dollar versus the Brazilian real. Make sure it's a liquid currency pair and make sure that it would typically be a pair that you would trade.